Hi, my name's Roger Schluter. This video is the one, the financial analysis. And this is, if you can stick through this, it'd be really good. But I do know some people, especially people that are creative people, sometimes they really don't like the financial analysis part. I mean, pluses, minuses, division, and multiplication isn't the most fun thing in the world to do. But this is very valuable. And the more of this you do, the more that the bank will want to approve your loan, because what you do is you're doing a lot of his work for him, and a lot of times he can make up his mind fairly quickly and then kind of fill in all the blanks later. So anyway, lenders follow a path when they're doing it. I follow a certain thing when I'm looking at financials or projections. Basically, I am looking at the income statement, the earnings statement. And that is your sales minus your cost of goods sold minus your expenses equals your net earnings or net income. That's really the one I look at first. I'm not looking at the balance sheet for a while. I'm looking at them. I'm really going to focus, number one, on what are sales doing? Are sales going up? Even if they're going up and down, is the trend up? And sometimes you have to look at more than 3 years for that. So if you have a business that's kind of choppy, you might want to look at like 5 years of income statements. The other thing is the earnings, the yearly earnings, income. What are they doing? I mean, hopefully they're going up. Hopefully you're not losing money. We have gotten businesses that have been losing money, loans before, and usually it's a change that's going to happen. And I think I've talked about that before. But when I'm looking at sales, the one thing I do is if the sales percentage isn't given next to it between the two numbers for the first year and the second year, between the second year and the third year, I'll go ahead and do that calculation real quick and figure out the percent increase of sales in year 2 and year 3 if I'm looking at 3 years. I'll do the same for earnings. I'll look at the percent. The sales is the change from year to year. And the earnings kind of is too, but you also want to look at the earnings as a percent of sales. And so anyway, the sales trends should be going up. The trend of projected sales should be going up. The trends of income should be going up, and the trends of projected sales should also be going up. So just keep that in mind. If you're doing projections and your sales aren't going up, the bank's going to say, "What? Come on, you got to put your best foot forward here. You got to show them that you're going to make it." When analyzing the income statement, you also want to look at expenses. One of the most important is cost of goods sold, and that would be, I've said this before, like if you're selling shirts, the cost of goods sold would be the shirt basically, and then the cost of that shirt, and then you're going to mark it up, and hopefully your markup after you sell all these shirts will cover the rest of your expenses, and you'll have a profit left over. The fixed expenses should also do that. Now, when on cost of goods sold, you always want to do a percentage of sales. You don't really care what it does from year to year, but you do want to know what the percentages of sales are, because if the percentage of sales is actually going down, that's probably great. But if it's going up, it could mean future losses in the future. So bankers definitely want to look at that percentage of sales for cost of goods sold. Now, for the rest of a lot of the fixed expenses, they're going to do the same thing. We're going to look at the percent of sales. So, eventually, all these fixed expenses, even though they're fixed, the rent, the electric, whatever, in 1 to 3 years is probably going to remain about the same, but eventually it will go up. In growing companies, they're going to use more resources. They're going to have more trash. They're going to have to move into bigger quarters. So these fixed expenses will eventually go up, but usually in 1 to 3 years, sometimes they will not, unless you are going to have to, unless you're rapidly growing, you think you're going to need to move in 2 years, then they might change. The cash flow is very important, and that's what a banker looks at. That's what a lender looks at. Cash flow is actually the earnings, and you add back any of the non-cash charges, and that's your cash flow. Now, you want to take that and then take your total debt. and you want to take your cash flow and divide it by your total debt. And that's your debt coverage ratio. The cash flow divided by total debt service per year. And it's got to be greater than 1. 1 would mean that your cash flow just covers your debt. And that's not what a bank wants to see, because then there's no profit, and you can't cover, there's no profit left, and there's no, who knows if you're going to get a paycheck. So banks want to look at a debt coverage ratio of at least 1.2 to 1.3, and then SBA can go as low as 1.1. Really, the sky is the limit. If you I've seen businesses that have a 3, a 4, a 5 to 1. So those are really the best. But a lot of times we're not talking. You've got a small business, and you're trying to make it. So anyway, the higher the better for the debt coverage ratio. I will spend a minute looking at the balance sheet. Balance sheets are assets minus liabilities assets minus liabilities equal equity, but your assets equal your liabilities plus your equity. So anyway, assets, you want the assets to go up faster than your debt is going up. And you also, lenders are going to want to see that equity is growing. And really, if the equity, if the company is liquidated, equity is what is left. What's left to the company, to the owners if they have to liquidate, or to the bank if they have to liquidate. Cash, we look at cash. Is it going up? Is cash large? Some businesses carry a large amount of cash just as a cushion. And then the equity, do you even have equity? Some businesses don't have equity when they start up. So the balance sheet really on when you're getting a loan, unless you're an existing business that's been a business for a while, you really don't want to look at the balance sheet. You want to keep focusing on the income statement. The biggest ratios that you want to look at on the balance sheet would be working capital, which is current assets minus current liabilities. Working capital is the money that's there to work with that's not already pledged during the year. The other is the current ratio. Current ratio is current assets divided by current liabilities. This should be it should be 1. It can be good if it's more than 1 to 2. And then there's the quick ratio, and sometimes called the acid test ratio. And this is actually where you take your liquid assets, your liquid current assets would be cash, accounts receivable, and then you subtract out. You don't count inventory. So cash, accounts receivable divided by current liabilities, and that gives a more I guess a stricter test to really whether you have enough money to make it throughout the year. Large companies, we might look at the operating cycle, and that's really not going to be covered here, but operating cycle would be how many days inventory you have plus days receivable, and then you'd subtract out days payable, and that would be your operating cycle. Now that's a very simplistic view, and operating cycles can get complex. On the financial analysis, loan officers will have items that they consider most important. I do. I got my stuff I look at. I start out with sales, then I go to earnings, and I hopefully have them on a spreadsheet. If not, I'm going to put them on a spreadsheet. And that is absolutely, you really need to do that. A bank's going to say, hey, we need 3 years of your tax returns. And if you have a Schedule C, that might just be income statements. So anyway, but you don't just want to give him those documents and then he has to sit there and put them on a spreadsheet. You really want to put them on a spreadsheet. And I've said that in earlier on how banks look at financial statements. And then I've also got another video of projections. And both of those kind of walk you through that spreadsheet and how that should look. If you're really going to talk to banks, you need to talk to several banks. And that's important because we all look at the same stuff you're thinking. You're thinking, oh, Roger looks at the same way that Fred over here does. And this big bank here looks at stuff the same way this little bitty bank does. I guarantee you they do not. I guarantee you they have certain things that excite them, and they got certain things they hate, and those may not be the same. So really, if you're going to look at banks, you want to look at a number of banks, because loan officers do the financial analysis different, and some may take liberties and some may not. Some may just look at your thing and there's one thing that they say, I'm not doing this loan. So anyway, one bank could approve it, and another one could deny that loan, and it's usually based on the same numbers. So anyway, I did have a loan, and I talked about this in a different video, but where we had a kind of a gym, and we called 4 banks and had them come down and just see the way everything worked, the workout routines. And they all came, and one was a neighbor actually. And the out of the 4, we had one bank that didn't care. We don't know what happened to him. The other bank came a day or two late, and they weren't that interested. And then we had the neighbor who turned it down. And then we had the other bank that actually did it. So really, that's the way you look at it. And they were doing their financial analysis different, I guarantee you. So anyway, that's the end of the video. If you got any value out of this, if you could hit the like button, and of course subscribe if you want to see content like this in the future. And I'll try to definitely put out 2 videos a week. So anyway, thank you very much. See you next time.